Hi everyone, this is Kevin. So you probably heard about the negative oil prices and wondering how is it ever possible that someone is going to pay you as opposed to charging you to take their oil away. Today we are going to explain what caused the negative oil prices and what you should know before trading futures. Futures are financial derivatives that obligate the parties to transact an asset at a predetermined future date and a price. Futures trading started in 17th century Dutch Republic, where people used it to speculate on the tulips while they were still growing in the fields. The first future exchange market was the Dojima Rice Exchange, established in 1697 in Osaka, Japan. At that time, the samurais were being paid in rice rather than gold for their services to the feudal lords. However, the rice prices fluctuated a lot between each harvest, and since the samurais were better known for being warriors rather than speculators, with the futures, they can easily lock in the monetary value of their salaries in rice so they can focus on samurai stuff without worrying about the future incomes. Now, what if different merchants deliver rice in different grades? Or in general, how to make sure the qualities of commodities are consistent regardless of the counterparties delivering them? The solution is standardizing the contracts. The Chicago Board of Trade listed the first ever standardized grain futures contract in 1864, and this marked the beginning of modern futures trading. To avoid the chaos of different qualities, the exchanges have very specific guidelines of acceptable grades of the commodities. This is an example of physical gold accepted by Chicago Mercantile Exchange, or CME. Getting back to our topic, today the two most popular grades of crude oil are WTI and Brent, with the former extracted in Texas and the latter in North Sea. These two grades also differ in chemical composition. Although the prices of WTI and Brent are positively correlated, they are not necessarily the same. In fact, on April the 20th, it was the WTI contracts that dropped to negative $37, while the Brent futures closed above positive $19, which is shown in the orange line. So what caused a plummet of WTI futures, while the Brent futures remain relatively steady? The answer lies in the little town of Cushing, Oklahoma. Cushing is a delivery hub for WTI-grade crude oil. According to one Goldman Sachs analyst, 77% of Cushing's oil storage facility had been filled as of April 17th. Here is a chart of the oil storage prices. We can see that the storage cost spiked from just under 10 cents per barrel to as much as 55 cents per barrel in less than 1 month. For land-based or landlocked oil producers, this means only one thing. The local oil price they receive very quickly goes to zero or even negative, because if they have too much oil and the shutting down production takes time and money, they must pay someone to transport it away until they manage to shut it down. And I've heard that when WTI was trading near 1 cent, some people actually dumped thousands of dollars into the futures, thinking in worst case they lose a few grands, no big deal. However, this is wrong. Again, this is not stocks. It is actually possible to lose a lot more than that if not being careful, which we will explain shortly. But first, let's go through some basics of futures trading. Step 1. KYC, for Know Your Contracts. You might be surprised by how many people who have never read the specifications of the futures they have been trading. This is an example of WTI future specs from CME. It shows that each contract is worth 1,000 barrels of oil, which means $1 change in the price per barrel will result in $1,000 of gains or losses per contract. On the settlement page, you can also find the first and last trade day of each contract. This is very important if you're trading deliverable futures without the intention of taking delivery, and we will see how this will end up in disasters if not being handled properly. Second, the settlement methods. Let's take a look at these two future specs. They are both WTI futures and their sizes are both 1,000 barrels. Can you spot the biggest difference? That's right, the one on the left is physically settled and the one on the right is financially settled. What does that mean and why do we care? Well, initially, all the futures are supposed to be settled physically between the producers and the consumers of the commodities. However, these days, many futures of non-deliverable underlyings has been introduced. For example, the stock index futures and even the weather futures. Stock index and the weather are not something that can be physically delivered. So this type of futures are financially settled, meaning the contracts will only be settled in cash upon expiration. Now, if you trade futures and don't want to get involved in the physical settlement, you will either need to A. Close your positions before they expire, or B. Trade the cash settled version of the contracts if they are available. Speaking of settlements, I had a crazy story to tell you. There was a brokerage firm who had a client who regularly enters into long futures contract on live cattle for hedging purpose, and they usually close out the long positions on the last day of trading. However, the new employee at the brokerage firm made a mistake that instead of selling one contract on the last day of trading, he instructed the trader to buy another one. By the time this mistake was discovered, it already passed the market close. Now, the brokerage firm ended up with 2 long contracts of live cattle. Since they were deliverable contracts, they had to dispatch this new employee to the live cattle auction site, which is 2,000 miles away, to take the delivery. To make things worse, they cannot auction off the live cattle immediately. According to the auction house rule, they have to wait until the next auction, which is a week later. Eventually, this broker had to make arrangements for the cattle to be housed and fed for an entire week until the next auction begins. So if you're trading deliverable contracts, make sure you close your positions before they expire. Third, margin and leverage. One major advantage of futures over stocks is that futures usually give you a much higher leverage. Let's say you want to trade gold futures. Each gold contract equals 100 troy ounces of gold. Currently, the gold is traded around $1,700 per ounce. Therefore, each contract gives you $170,000 worth of gold exposure. In order to enter into one contract, you don't actually have to pay the full price. You only need to put down a much smaller down payment of $10,065, which is called the initial margin. Now, if you're getting an exposure of $170,000 worth of gold, and when the gold price rises by 1%, you will make a profit of $1,700, which means you made a 16.89% return on the initial margin you paid. Even though the gold price rose by only 1%, futures just gave you a 16.89 times leverage. Now, what if the gold price drops by 10% instead? Similarly, a 10% loss on $170,000 equals $17,000 loss, which translates to a negative 168.9% return on the initial margin. That's right, not only you lost all of your initial margin, you also owe your broker almost another $7,000. To avoid this situation, the exchanges require a maintenance margin. When your margin balance is below the maintenance margin, in this case 91.50, you will have to post additional collateral, otherwise the brokers will be forced to close out your positions to avoid further losses. You've probably heard of some hedge funds are getting margin called, and that's what happens when the losses are so big for them to sit on their positions and wait for them to come back. Lastly, some people are asking, how about just buy some ETFs like USO? Well, the short answer is these exchange traded products also suffer from something called the roll yield. Let's take a look at the prices of different expiries. We downloaded the futures data from Hystake.com. Hystake is an open marketplace for financial data where you can explore, share, and monetize interesting data sets. Going back to the price table, in the highlighted row, notice how only the May contract is negative and the contracts of June through August is positive. Well, people price different maturities differently because they represent different storage, financing, and insurance costs. If we plot these 4 contract prices on April the 20th, it should look like this. When the term structure is upward sloping, we call it the market is in contango. Similarly, if the term structure is downward sloping, we call the market is in backwardation. If you long futures, the contango will cause negative roll yield and the backwardation will cause positive roll yield. To understand the roll yield concept, let's assume the May contract is about to expire, and the USO will have to sell the May futures at negative $37 and replace it with the June futures at $20. During this process, $57 was lost. It is not too hard to see that the steeper the slope, the more losses will incur. In reality, the markets are in contango most of the time. Therefore, as the USO keeps rolling the contracts forward in the contango market, the ETF will keep losing money. Another example would be the VIX index versus VXX, which is the ETN that is supposed to track VIX index. Because VXX has to use futures to track VIX index, we can see in this chart that it has accumulated enough negative roll yield to deviate from the actual index over time. Of course, ETFs or ETPs are a lot more complex than that, and we will explain the nuances in the future videos. Thanks for watching, hope you like our video and don't forget to hit the like and subscribe button. Have a nice day.